Welcome to Inevitable Wealth from Liberty One Wealth Advisors, a conversation around financial decision-making and events around the globe. In the age of instant information, level heads can be hard to find. Our hosts, Guilian DiLeonardo and Jacky Petit-Homme, provide objective and relevant insights to help you parse the data and block out the noise as you build your wealth. As managing partners of Liberty One Wealth Advisors, Guilian and Jacky look to empower you to develop an increased understanding of financial markets and how they impact you.
Hello, everyone. Welcome to our 8th episode of Inevitable Wealth. We're looking to clear the air around complex topics and misleading headlines that we all come across in our everyday life. I'm Jacky Petit-Homme, and I'm here with Guilian DiLeonardo. Guilian, how are you today?
Good morning. Good morning, everyone. Hope everything is going well. How are you, Jacky?
I'm doing well. I can't complain. It's Friday, the day that we're recording this, and Friday's favorite day of the week. The optimism of the weekend is here. It's nice out, so it's hard to be in a bad mood. Yeah, got to do it. So, what's on the docket today, Guilian? What are we talking about?
Today we have high level, right? The 5 questions of financial planning. So as you evaluate things going on in your life, the goal is to be able to answer each of these questions in some semblance of an effective strategy, right? And these are things we help address with our clients. Anything to add to that?
Yeah, we're gonna try to keep this concise and high level, like Guilian said, but of course, these questions can be very complex and take a much longer conversation. But there's just a framing that you should be able to answer these questions when thinking about your financial situation. So let's get into the first one. What's the first question, Guilian?
What happens if I live?
Yes. What happens if I live? Which is the good one, right? This is what we want. We want a long, happy, healthy retirement, right? So back in the day when the typical retirement was 20 years, and that's what planners used to plan for. But today, with statistically, right, with medical advancements, longevity has kind of grown, right? The statistic is about 47%. If you're married or a couple, you have a 47% chance of reaching the age 90. So making sure you have a plan in place so that you don't outlive your money. There's a lot of different ways to do that, making sure you have the right allocation that's in your favor. Also, starting young, right? Saving early and often, right? The bigger nest egg you build when you get to retirement, right? The more flexibility and more optionality you have. Guilian, anything to add to that?
No, I think it's very clear, right? The earlier you start saving, the more impact you can have from a growth perspective, right? Just because you have more time. With that, you also want to control the controllable. So meaning taxes. Certain years you can really plan out your effective tax rate, knowing that typically when you're younger, you're taxed at a lower rate because you have less income. You hit your prime earning years around 60, 50. And then we do have a lot of families that we help that retire around 60, 62. They're not taking Social Security yet. And there's a great window there to take advantage of lower tax rate because they have lower income and do things like Roth conversions and different types of strategies.
Yeah, that's a good point. And also, looking at income, retirement, Social Security, one thing that we always want to talk about is planning for inflation. Inflation has been a very popular character in the news the last couple of years, but it's something that's always been around, right? So plan for inflation, especially for increased healthcare costs in retirement. Of course, healthcare costs, folks don't know this, are basically 4.5-ish% increase every year. So it's actually higher than inflation. So ensuring that when you are looking at your spending plan and running those projections, that those are accommodated for. And also, if I may take this moment, Guilian, so we are recording this in March, which is National Women's History Month. So I wanted to also talk about women in longevity and longevity, excuse me. Women tend to live 5 years longer than men. They're 80% more likely to be impoverished after 65. And the real reason behind that is if the husband has a health issue, and they go into a long-term care facility and the savings or insurance is in there, they spend a lot of their resources, and then unfortunately the surviving spouse is left behind. And women make up 70% of nursing home residents. So I just realized that was like a pretty sad thing to see on National Women's History Month. I'm sorry, but it is a good thing, right? So plan, understand that, and we'll move on, because I just realized after I was saying that was a pretty sad note. I'm sorry, but happy National Women's Month.
Yes, and
yeah.
on that note as well, interesting fact that Social Security is gender neutral. So comparatively, if you were to buy an annuity or go through a private company to receive that type of income, if you are a woman, you would get a lower benefit because they would expect you to live longer. So that's another way you can sort of strategize around Social Security, knowing that you have a longer life expectancy and thus can incorporate that, knowing that the government doesn't incorporate it. So that's always can be impactful as well.
Nice. All right. So that was the first question. Second question.
Equally thrilling, equally positive. What happens if I live was number one? What happens if I die? Number two, right? So you can go back to a slight degree of morbidity.
So, hey, what happens if I die, right? Hopefully I'm not, spoiling alert here for anyone. No one's going to be here forever, right? And one of the biggest risks, especially if you're a young family and you're still building your nest egg, building your resources, is unforeseen premature death. And I hate to say it, but God forbid something happens to you, right? That, of course, the mental duress, the emotional duress is going to be there, but we have to do our best to make sure there isn't added financial duress on top of that. So making sure you have a good life insurance policy in place. We did have an episode, I believe, I don't remember which episode number, that talked about insurance a little bit more detail, but there's basically term insurance, which is you pay it for term, whole life, you pay for your whole life. And making sure you have health insurance covered, God forbid something happens, that you could take care of your family. Anything to add, Julian?
It's a very common thing we do is analyze the expected amount and type of insurance coverage you have to ensure that you're covered for both you and your family. So it's always important to do. At minimum, can reaffirm that you're in a great position. The other component that we help a lot of families out with is their will, right? So we did invest in software, and we've talked about this with all the families we serve, as well as on different podcasts as well. We invested in software that enables the families we work with to do a will in about 35 minutes is the average time. So very effective way to get that baseline foundation in order, and a really great tool for everybody to use. What would you add to that?
Yeah, and I would also say a very large percentage of families and just people basically don't have a will. And I would say a big push of why we invested in that platform was, they're families that we've been working with 5, 6, 7 years, and the number one item on the list was getting a will for the entire 7 years. And folks are busy; it kind of gets on a back burner. It's hard to find an attorney, or there's also a cost becomes cost prohibitive. So, the platform helped individuals just put aside 35 minutes, 45 minutes, and just kind of get the will done. And also, an important thing about a will, especially if you have young children, is in the will, you point out who you want to be the guardian, God forbid, both parents are not around. So make that decision for your family so they don't have to try to figure that out, when, if God forbid something like that happens.
It's usually quite simple and seamless. Anecdotally, in my family, I've spoken to my dad about it for the past probably decade or so. Hey, just don't care what it says. You just need one, right? Because if you don't have one, it becomes my problem, right? One day you pass. I have three siblings and myself. They have a complex life that I would then be stuck dealing with and organizing everything that they have going on. He consistently meets with a lawyer, looks at wealth.com, never actually signs the documents. So that is a very key component of whatever it is you're looking to accomplish for you and your family. Sign the documents, get it done. It can be edited, right? So once you do it once, it's not set in stone, right? You update it regularly. It's a living, breathing document. So when you listen to this, Dad, please just do it because I can't keep bothering you.
Yeah.
Please.
Also, to that point, make sure you revisit it every 3 to 5 years. If you move from a different state, right? We're in Philly. Folks move to the, to New Jersey, right over the bridge. That's a different state. You have to get it updated. You have children, all that stuff. So make sure you review it as well. Just because, same thing. It's living, breathing. You got to make sure we take a, we take a good look at it. Next question here. What's number 3, Julie?
What happens if I get sick?
There it goes. So this is a multifaceted, right? Let's talk about younger years and then older years. So, of course, the first thing about if you get sick is making sure that you have optimized health insurance coverage. So whether it might be through work, or if you're a business owner, it might be a private policy that you get on your own. But having obviously good health insurance, right? We insure everything else. We insure our health as well. Would be the first thing, right? If it's a younger, more short-term thing, what we typically recommend folks is always to have that emergency fund, that 3 to 6 months of fixed expenses in case you can't work, because that's kind of like your fire extinguisher, right? Well, if you're sick, you can't work, you have your expenses covered. And then also making sure you're taking advantage of those health savings account or a flex spending account. We could get into the detail about that, but a health savings account, they're basically tax preferred accounts that help you pay your medical bills. Second thing is disability, right? So we're talking about what happens if I die, right? God forbid something, you get in an accident and then you're disabled and you can't work. So ensuring you have disability that covers what your income is needed to cover those expenses. Disability, there's a lot of different types. There's short-term disability, long-term disability, which is traditionally over a year. Some policies can cover you up to, if you have an event that you're labeled disabled, will go from, if you are 40 up to 65, 67, they cover you for life. Usually the target is looking for covering your expenses. So that's if you're on the younger side. If you're getting older, right, one of the biggest things that we see can put a risk to a retirement confidence is long-term care, right? So Julian, what would you say is some of the things we've seen, especially in the long-term care space, and how we've been helping folks kind of plan around that?
No, absolutely. There are a lot of different policies and types of things to incorporate. Now, a lot of the folks that we talk about being self-insured, right? Where they have enough assets to cover themselves, and that's totally understandable, right? Can be a reasonable strategy. We always want to make sure that when you do that, it is an actual separate account set aside for these type of expenses, because it is the statistic, Jacky, you would know off the top of your head, a high possibility, right, that a married couple will experience some sort of long-term care event and will be able to be positively impacted by insurance.
Yeah. So the statistic is a 70% chance some form of a long-term care event, could be short or long. The average long-term care event is 2 years, 2 to 3 years. And on average, again, folks, I'm just saying averages, right? It's between the ages of 77 and 80 when these events happen. So Of course, these are all averages. We can only plan with the variables we do know. And to Julian's point, you got to know how we're going to address this, right? Some folks say, hey, listen, I'm just going to spend down. We're going to have an account. We're going to save for it. And this is going to be our bucket. Some people say, hey, listen, I had to deal with this with my parents. I don't want anyone else to deal with this. They use insurance, right? I think everyone is very well aware of the high cost of long-term care. In PA, the average home health aid is $5,000 to $7,000 a month. If you have to go to a skilled facility, it could be easily $10,000 to $12,000 a month.
Mm-hmm.
So it's high cost. So make sure there's got to be a plan around it.
And what Jacky is the ideal time to look? Because we talk about planning ahead. When is an ideal time to start getting educated on it, whether you elect to pursue a policy or just be more knowledgeable on the space?
Great question. There's two answers there. So it's never too early to get educated on it. That's my little commercial. But also, I'd say we typically say 50 to 55, depending on some personal factors, you know, your health history, your familial history, right? That we start to really talk about it and really look into it. But it's never too early. You know, there's a family that we serve that both of the parents had neurodegenerative disorders that were early onset. So we're talking about planning, and they're in their 40s, and we're kind of doing that thing. So it's never too early, but again, traditionally around the 50, 55 age. So,
Awesome.
So yeah, so we've had what happens if I live, what happens if I die, what happens if I get sick, and then the next question is, what happens if I get sued? And I think we've talked about this before again, but you know me, I talk about this a lot. Julian, can I take this one?
Yeah, walk us through your anecdote briefly on your personal. I've heard it so many times.
I got sued. I had a I had a property that I lived at, and then I moved to another place, and I turned it to a rental. 2 years later, I got sued because someone claimed they slipped on ice in front of our condominium. It was a condo. It's like 2-story, 2 different units in that building. And the reason why I shake my fists at the sky about it was because this person's story was that they slipped on ice, and with all the mounting evidence that it hadn't snowed in over like 8 days, and the average temperature was over 50 for the 8 days prior to the snow, the insurance agency still settled out and paid this person. She supposedly broke her ankle, showed up to the thing with no issues. Like, so you do the right thing, you know, you try to do the right thing, and you could still get sued, and you could still possibly lose. So get umbrella insurance. It's more cost effective than you think. Same thing, a client who we work with, she actually got hit at a stop sign, 4-way stop sign. The interaction was calm, and then the next day, the person claimed that she was texting and driving. And I'll tell you, this person does not even know how to text. But now she's getting sued beyond her limits, right? Umbrella policy covers you beyond your insurance thing. So if you own a business, if you own a dog, if you own a property, it's a couple $100 a year for like $1 million of coverage. You could get it typically through any property and casualty. And I'll tell you, this will be my passion to tell everyone every single time we talk about it.
Yeah. And if anything, both stories essentially, even when you settle, right, it really comes down to how expensive lawyers are. So tools like umbrella insurance, tools like LegalZoom, a lot of folks get through work. Even when you're right, it can still cost you, right? Yeah. And I think that's what you've seen with both situations there, is that having the backup, the insurance to both protect you in the event of a real situation, a real disaster, as well as one manufactured by bad actors per se. Yeah. Always important to mitigate that cost.
Cool. So hopefully, Julian, how did I do that? Keep that brief enough?
It was good. It was good. I've heard it a couple times, so I was trying.
I think everyone's heard it a couple times, but hey,
It's important. It's
it's,
impactful. But
yeah. All right. So, all right. Last question. Who gets my money and how? And also imagine in parentheses, I put or children in case, you've still got young children under 18. And this is your basic estate planning conversation, right? There's a lot of different ways to cut it. We just had an episode about the Tax Cut and Jobs Act. So if you do have an estate that might potentially be over that 5 million mark, make sure you're planning actively with a state attorney. But we could talk, I would say lightly, Julian, like the difference between like a trust and a will, because we get that question a lot, especially when we launched that platform. So anything to add before we kind of get into that?
What would you see to be a few core differences?
I would say the core difference really is the trust. I'd say in trust, imagine the trust is kind of like a safe, right? And there's two different types of safe. There's a revocable and there's an irrevocable. So a revocable trust is exactly what it sounds like. You can take whatever you put in there and take it right back out. So some folks, if you're in states like California, where you have a tax if you don't have a trust, or in Florida, where the probate is just known by all the state attorneys to be an absolute nightmare, some people have opted to take advantage of a revocable trust because it's just the complexity of their lives. And that's basically you put your assets in this trust and it's a safe. And basically the beneficiary could be whomever, your spouse, your children, right? And it basically provides protection. You definitely need an attorney, right, to set this up. And it doesn't require probate, right? It kind of goes outside of that. And basically the assets remain in the trust until the beneficiaries inherit them, or, like I said, it could get complex. You can put rules on it, right? Hey, they got to reach 25 or 18 or whatever it is if you have young children. So that's kind of like the trust. And then the irrevocable is once you put it in there, once it's in that safe, you can't take it out. So that's the basic differences. And then the will,
it's a lot more.
Yeah.
Irrevocable applies a lot more to the higher net worth you are, the more you can incorporate that into your estate planning to help reduce the estate tax. Because if you are charging estate tax, which sunsets, we spoke about it before, it's expected to, right, go down to about 12 million. Anything over that would be taxed at roughly 40%. It's gradual, but it moves very fast up to that 40% base. So it's important to have a plan for that.
Yeah. And I would also add, there's, again, please speak to planner, an attorney, and also a tax advisor, because when you get into trust, folks set them up, and sometimes they'll do all this work, get the documents, set up the trust, and then it's kind of like the safe, and then they never move anything into it, right? And it's kind of like, to your point with your father and getting the will done, but never actually signing the document, right? If you don't kind of get across the finish line, all that work and potentially money you spent setting up that trust was kind of a waste. A will is basically, it's your last will and testament. It states exactly who you want to be beneficiaries, who you want to be an executor or executrix, right? There's the person who is gonna carry out your wishes. And like I said before, it designates a guardian for your children if they're a minor. And but one thing is it's not private, right? So a lot of reason why some people like to trust is because it keeps your information out of a public record. The will, it does not. And a simple will, right? In most folks could get by with a simple will, and we call it like the sweetheart will, right? So for instance, something happens to me, God forbid, everything goes to Ashley, my wife, and vice versa. And then God forbid something happens to both of us, everything goes to my son, Quinn, right? We call that a basic sweetheart will. And there isn't anything specific. We're not excluding certain assets. It's very basic. You could get that done most of the time without an attorney. Anything to add to that, Julian?
I talked about it before. Lawyers expensive. So especially in regards to probate in certain states, if you go through probate in the state of Florida, I've been told it can cost anywhere from $30,000 to $60,000. That comes out of your estate to essentially pay the lawyer to assist, navigating all of this. So the more simple you can make it, the more effective you can make it, the more streamlined you can make it, equals the more cost effective you can make it.
Yeah.
As you can imagine, probate, big business in Florida. So always want to make sure that everything is as streamlined as possible.
Yep. Yeah, I mean, I think that's pretty good. I don't know how long that was. Hopefully it was nice and concise. I have not been paying attention to the time.
I have one more. I have one more.
Oh.
So along with who gets my money and how, or children, right? And kind of navigating that component. Always good to evaluate. We talk a lot about money and legacy planning, but always good to evaluate the values you want to pass along. So ensuring that you are, of course, working with your children and family and instilling those as you go. But it can be really impactful to write those types of things down, whether it's on a piece of paper, handwriting, it's more established, whatever it is. I think that can have a huge impact, because for a lot of the families we serve, they built up this nest egg. They talk a lot about legacy planning and helping the next generation. And then upon their passing, there are no guidelines, right? There are no, they don't have to be rules, but there's no sort of structure for what they believe the funds should be going for. And for most people, what they want is their children to be happy, their grandchildren to be happy. So writing that down in terms of how you see those funds and that value coming into play can be really, really impactful for them as they navigate their next steps as well.
That is a wonderful point, Julian. Thank you for adding that. I forget what do we call it, but like really just like a family mission statement.
Yep, exactly.
And I know some families, right? They're very sensitive to, knowing what their children have, having their children know the details. They don't even know the details, but knowing more of the qualitative side, right? Like what's important, right? Because you worked hard, right? And you earned this nest egg. So having them know that those intentions. And speaking of documents, one thing too, I want to mention is make sure you have somewhere that's easily found, just a list. Like keep your documents, like your will, where your accounts are, for your survivors to know, right? Because God forbid something happens to you, and they don't know where you bank or where you pay your mortgage or something. It's going to be a lot of search and find for those accounts. So, we try to provide a net worth statement for the families we serve, which helps kind of show where everything is on one piece of paper. But keep those document lists updated. So, God forbid you're not here, people know where the accounts are, and there isn't anything missing from the picture.
Exactly. So. A lot of different questions we try and answer today. The 5 questions of financial planning, just to review. What happens if I live? What happens if I die? What happens if I get sick? What happens if I get sued? Who gets my money or children, and how? Jacky, take it away.
That's it. We're done here. Thank you everyone for listening. We also do take requests. This 5 questions was actually someone he said, hey, like, can you put kind of a podcast together? So if there's something you want us to talk about or just kind of break down, happy to do it. Thank you all again. It's Friday here. If you're listening on Friday, have a good weekend, have a good day or evening, and we'll see you again.
Have a good one, everybody.
Liberty One Wealth Advisors is a registered investment advisory firm located in the state of Pennsylvania. Any options expressed are derived from sources generally believed to be reliable and are provided for informational purposes only. It does not constitute any form of advice or recommendation to buy or sell any securities, adopt any investment strategy discussed, or invest in any specific product. Nothing contained in this podcast constitutes investment, legal, tax, or other advice, and is not to be relied on in making an investment or other decision.